The candlestick is composed of three key components. The body of the candle is formed by the opening and closing prices, while the high and low prices create the upper and lower shadows of the candlestick. In summary, we have the body, the upper, and the lower shadows. These three elements play a significant role in forming various candlestick patterns. Bearish and bullish candles. It's important to understand that a bear candle forms when the closing price is lower than the opening price within a given time horizon. Conversely, a bullish candle is formed when the closing price is higher than the opening price for that specific time frame. Time horizons can vary, ranging from 1 minute to 15 minutes, or even extending to 1 day or a week. Each candle on a chart represents one unit of the selected time horizon. For example, if you choose a chart reflecting daily transactions, the time horizon would be 1 day. In this case, the opening and closing prices on the candlestick depict the opening and closing prices of the underlying instrument for that particular day. Upper and lower shadows. Let's delve into the highs and lows of the candlestick, as illustrated in this graphic. The area between the highest price recorded during the day and the opening or closing price of the day, depending on whether it's a bearish or bullish candle, is referred to as the upper shadow. The length of the upper shadow is determined by the difference between these 2 points. The greater the difference, the longer the upper shadow. A similar scenario unfolds in the lower regions of the candle. Here, the difference is calculated between the lowest price recorded during the day and the closing or opening price, again depending on whether it's a bearish or bullish candle. Buying and selling pressure. Another noteworthy aspect is that the difference between the opening and closing price shapes the body of the candle. A longer body signifies a day characterized by a one-sided market. For a bearish candle, this suggests that there were more sellers than buyers throughout the day, indicating selling pressure on the underlying instruments. Conversely, a bullish candle signals that there were numerous buyers during the day, exerting buying pressure on the underlying security. A candlestick pattern is a movement of price in a candlestick chart that technical analysts believe could be used to predict the overall direction of the market or the price of the underlying security within a given time horizon. In most cases, candlestick patterns occur infrequently within a candlestick chart. However, there are occasions when the patterns can be traced sequentially, with one leading to the other. This is why technical analysts use more than one indicator or strategy to confirm various patterns before making a trading decision. The most common candlestick patterns are breakouts and reversals. Breakouts tend to occur rarely within a candlestick chart, while reversals tend to take place after a certain pattern. For instance, reversals could occur after a sustained period of an uptrend, referred to as a pullback. When reversals occur after a continuous downtrend, analysts might label it as a recovery. However, for now, let's focus on breakouts. So, what exactly are breakouts? A breakout is a candlestick pattern that predicts a major change in the direction of the price of an underlying security after a sustained period of indifference or minor trends. Breakouts can occur in either a downward movement or an upward movement. When breakouts occur in an upward movement, it's called a bullish or upward breakout, while in a downward movement, it's called a bearish or downward breakout. Technical analysts try to map out various candlestick patterns to predict or identify possible breakouts. These candlestick patterns are what traders refer to as breakout candlestick patterns. There are several breakout candlestick patterns, and in most cases, Various analysts will refer to the same candlestick pattern by a different name. However, the most common breakout candlestick patterns include 1. Head and shoulders. This is a series of candlesticks in a candlestick chart that appear to form a head and shoulders of a human being. 2. Double top. A series of candlesticks that form two peaks and a trough, creating an image like the letter M within a given time horizon. 3. Double bottom. A series of candlesticks that form two troughs and a peak, resembling the letter W within a given time horizon. 4. Pennant pattern, marked by a sharp advanced decline, followed by a sustained period of small swings falling within specific support and resistance levels. 5. Bullish triangle, candlesticks forming upward trending troughs with relatively similar peaks within a given period. The pattern often shows an increasing sentiment of indecision in the market. Peaks and troughs can be joined to form a triangle, and when this occurs, there is usually an 80 to 85% chance that the follow-up breakout results in an upward movement. 6. Symmetrical triangle, candlesticks forming converging turning points in trending support and resistance levels. When this pattern appears, there is typically a 60% chance that the follow-up breakout will align with the direction of the initial trend. 7. Bearish triangle, a series of candlesticks forming a bearish trending resistance and a horizontal support. The opposite of a bullish triangle, there is an 80 to 85% chance that the follow-up breakout will be a downward movement. 8. E-flag, a series of candlesticks forming a contained upward-downward trending movement, preceded by a sharp uptrend-downtrend in the price of the underlying security. The downward-upward trending movement is usually within trending support and resistance levels. The preceding uptrend forms the flagpole, and the higher the preceding uptrend, the taller the pole. When you get the hang of technical analysis, you won't always need to draw shapes like triangles, flags, or pennants. You can spot them easily just by looking at the candlestick chart. This makes your decision-making process quicker. It's important to use different indicators like MACD, the stochastic, and RSI to double-check the trend shown by the breakout candlestick pattern. I hope you enjoyed this video. If you have any questions, feel free to reach out to us via WhatsApp at the provided number. And, of course, don't forget to subscribe to our channel. We'll be sharing more trading-related content here. Thank you so much for watching. Stay tuned for our next video.